Forex Fundamentals and Trading. Chapter 12, Trading Psychology. Section 1, Emotional Discipline. Emotional discipline means following your trading plan exactly as written, especially when the market feels uncomfortable. It does not mean becoming emotionless, because fear, doubt, and excitement are normal parts of trading. The real skill is refusing to let those feelings rewrite your rules in the moment. Discomfort by itself is not a trading signal, even though it can feel urgent and convincing. A disciplined trader keeps asking, "What does my plan say?" instead of "What do I feel like doing right now?" Over time, that habit protects consistency far more than trying to predict every move perfectly. Emotions distort decisions by shifting your attention away from analysis and toward immediate relief or excitement. After a loss, the brain can react as if something threatening is happening, which makes hesitation, panic exits, or stop changes more likely. After a win, the opposite problem can appear, because confidence can quickly become overconfidence. That can lead to larger position sizes, extra trades, or ignoring parts of the plan that suddenly seem unnecessary. In both cases, the market has not changed your edge, but your emotional state has changed your behavior. And once behavior becomes impulsive, consistency starts to break down. A rule-based response is decided before the trade begins, while an emotional reaction appears in the heat of the moment. That difference matters because emotional actions usually aim to reduce discomfort or chase a better outcome right away. Widening a stop out of fear may feel safer, but it actually changes the risk after the fact. Closing a trade early because your nerves rise may protect your feelings, but it can damage the expectancy of the system. Moving a target farther away out of greed does the same thing from the other direction. A simple test is to ask, was this action written into the plan before entry, or did I invent it because of how I feel right now? Trading rewards consistency more than certainty, because markets are probabilistic, not predictable trade by trade. A strong setup can still lose and a weak trade can still win, which is why single outcomes can be misleading. If you judge every trade only by whether it made money, you will be tempted to change good behavior after normal losses and repeat bad behavior after lucky wins. The better question is whether the trade was executed correctly. Did you follow your entry rules, respect your stop, and manage risk as planned? When you accept uncertainty and focus on execution, you give your edge a chance to show itself over many trades instead of demanding certainty from one. Emotional discipline becomes much easier when your rules are clear before trading starts. Vague rules leave room for interpretation, and interpretation often becomes emotional decision-making in disguise. If you say you trade in the morning, that can easily turn into trading whenever you feel like it. If you define a specific session, a clear entry pattern, a fixed stop rule, and a risk limit, then the trade can be followed or broken in an obvious way. That clarity reduces the chance that fear or excitement can quietly take control. Good rules should cover entry criteria, stop and exit behavior, risk per trade, and practical limits like trading hours or a daily loss cap. Before placing any order, build in a short pause and check your state honestly. This can be as simple as taking 10 seconds and asking whether the setup is present, the risk is defined, and your decision is coming from the plan rather than your mood. Anxiety, boredom, frustration, impatience, and overconfidence all create pressure to act before the trade has earned it. Naming the emotion helps because it turns a vague feeling into something you can observe. If the setup fits the rules, you can proceed with more confidence in your process. If the urge is mainly emotional, skipping the trade is often the most disciplined action available. Once the trade is live, the job is to manage it according to the plan, not according to discomfort. Many traders prepare well before entry and then begin improvising as soon as price starts moving. A small pullback can create the urge to widen the stop, and a favorable move can create the urge to chase more profit than the plan intended. Those reactions feel reasonable in real time, but they often turn disciplined execution into emotional management. Adjustments are only valid if they were defined in advance, and the required conditions are actually present. If not, respecting the original stop, target, and risk is usually the right response. A strong trading journal should record more than prices in profit or loss. It should also capture what you were feeling before the trade, during the trade, and especially at any point where you were tempted to change the plan. For example, note whether you felt calm, rushed, fearful, bored, or overconfident. and record any mid-trade changes you made. Also mark whether the setup was valid according to your rules. Over time, those notes reveal patterns that are easy to miss in memory alone. You may discover that boredom leads to weak entries or that losses tend to trigger impulsive re-entry attempts. Once those patterns become visible, discipline becomes something you can measure and improve. Hard limits are important because emotion tends to escalate once losses start to build. A daily loss limit is not only a risk control tool, it is also a psychological safeguard that protects decision quality. When that limit is reached, trading stops for the day, even if you strongly want another chance. That pause prevents a normal losing session from turning into revenge trading or oversized risk. It also protects your capital and your mental state for the next session. Stopping is not weakness. In trading, it is often one of the clearest signs of discipline. Maria's example shows what emotional discipline looks like in practice. She has already defined her risk before entry, risking $100 on a $10,000 account, so the decision is made before pressure arrives. When the Euro/USD trade moves slightly against her, the emotion changes, but the setup itself has not changed. She feels the urge to widen the stop, which is a very common reaction, but her written plan does not allow it. So she leaves the trade alone and lets the original risk stand. Whether that trade later wins or loses, the important part is that her execution stayed aligned with the process. That is the standard discipline traders try to protect. Section 2. Fear and greed. Fear and greed are normal emotions in trading, and neither one is automatically a problem. Fear can alert you to risk, while greed reflects the natural desire for reward and progress. Trouble begins when either emotion bypasses the trading plan and starts making decisions on its own. Fear may push you to avoid valid risk, and greed may push you to take more risk than your system allows. The goal is not to eliminate emotion completely because that is unrealistic. The goal is to notice it and keep your decisions anchored to a defined process. Fear usually shows up as an exaggerated focus on short-term pain. Instead of evaluating whether the setup is still valid, the mind becomes preoccupied with avoiding loss or discomfort right now. That can lead to hesitating on a good setup, taking profit too early, moving a stop farther away, or skipping signals after a losing streak. In each case, fear is pulling attention away from the trader's edge and toward emotional relief. Fear tends to increase after recent losses or when position size feels too large for your comfort level. So when you notice those reactions, it is worth asking whether the issue is the market or whether your attention has shifted away from the plan. Greed often feels positive in the moment, which makes it especially dangerous. It can sound like confidence, ambition, or a strong belief in the trade, even when it is really pressure to take more than the plan allows. Greed shows up through overtrading, increasing size beyond the plan, chasing an extended move, or holding past a target for no rule-based reason. It can also appear after a series of wins when the trader begins to feel unusually sharp or invincible. The problem is not wanting profits. The problem is letting that desire weaken tested rules. When greed takes over, discipline gets replaced by the thought that just this once, more risk will lead to more reward. Some market conditions naturally make fear and greed stronger. A strong trend can trigger fear of missing out, especially if you feel you are watching opportunity leave without you. A sharp sell-off can intensify loss avoidance and make traders want to exit simply because the move feels dangerous. Reversals are emotionally difficult too, because they create uncertainty and the sense that action is urgently required. Fear often peaks near lows, and greed often peaks near highs, which is one reason emotion can lead traders to do the wrong thing at exactly the wrong time. Feelings also tend to lag price. So by the time emotion is strongest, the move may already be close to exhaustion. That is why structured rules matter most in emotionally intense market environments. Fear and greed often follow a repeating decision cycle. First, something triggers emotion, such as a sharp candle, a news release, a losing streak, or a run of recent wins. Then the mind starts searching for relief from discomfort or a bigger reward. At that point, risk assessment becomes distorted, with fear making risk look larger than it is and greed making it look smaller than it is. The trader then breaks the plan through actions like early exits, oversized trades, or impulsive entries. If that behavior is followed by a lucky outcome, the habit gets reinforced, which makes the cycle even harder to break later. When emotion overrides rules, rule breaking becomes very visible in execution. Fear may cause you to skip a valid entry or take profit too early because holding the trade feels uncomfortable. Greed may push you to enter before confirmation or refuse to take planned profit because you want more from the move. Moving a stop loss is one of the clearest examples, because it often combines fear, hope, and a refusal to accept the planned risk. These actions may look different on the surface, but they share the same source. The system's rules are no longer in charge. Once that happens, the trade is no longer being judged by your edge, but by your emotional state. A trader can make opposite mistakes in the same day when process gets replaced by emotion. After a few losses, fear may cause hesitation on a valid retest setup, even though the rules are there and the opportunity is real. The trader watches the move reach target without them, which creates frustration and regret. Later, a fast news-driven move appears, and this time greed takes over. The trader chases late, doubles size, and enters without a hard stop because the missed opportunity still feels emotionally active. The market may not be the main problem in that sequence. Abandoning the plan is. Fear and greed can look different, but both lead away from disciplined execution. Emotional states often show up in the body and mind before they show up in your trading decisions. Tight breathing, a tense chest, sweating, racing thoughts, restlessness, or a sudden rush of confidence can all be early warning signs. These signals matter because they usually appear before the click, not after it. If you can recognize them early, you have a chance to pause before emotion turns into execution. That pause may only last a few seconds, but it creates a gap between feeling and action. In trading, that gap is often where discipline lives. Reducing emotional impact does not require anything complicated. Small, repeatable actions can stop fear or greed from turning into impulsive trades. Recheck the setup against your written rules, read your risk limits out loud before entering, and reduce position size if the emotion feels unusually intense. If you feel rushed, stepping away briefly is often better than forcing yourself to decide under pressure. And if you notice that control is slipping, the best decision may be to stop trading altogether for the session. These simple behaviors create friction between emotion and action, which gives your process room to lead. An emotion log helps turn vague self-awareness into something practical. After each trade, record the setup, the action you took, the emotion you felt, and how intense it was on a simple scale from 1 to 5. Then write one better response you could use next time in the same situation. For example, if you exited early out of fear, your improved response might be to hold to stop or target unless a planned management rule is triggered. Over time, that log connects specific feelings to specific behaviors. That makes improvement much easier because you are no longer trying to fix a general problem called emotion. You are working on clear patterns you can actually see. The key mindset is that your edge does not come from feeling nothing. It comes from recognizing fear and greed and following the plan anyway. No trader is immune to these emotions, so the goal is not to pretend they are absent. It is also important not to confuse impulse with intuition, because many rule-breaking decisions feel convincing in the moment. Position size plays a big role here, since oversized trades tend to make emotion louder and discipline harder. And one win or one loss should never be powerful enough to rewrite tested rules. Strong trading psychology is really the ability to stay aligned with process while emotion is present. Section 3. Revenge trading. Revenge trading usually begins after a loss, but the loss itself is not the core problem. The real issue is the emotional reaction it follows, especially anger, frustration, or embarrassment. Instead of waiting for a fresh signal, the trader feels a need to win the money back immediately. Focus shifts away from process and toward getting even with the market, as if the market owes a recovery trade. That mindset is dangerous because it turns a normal business loss into an emotional trigger for more risk. A loss can be acceptable within the plan, but acting from emotional pain is what creates revenge trading. Revenge mode has some common warning signs, and they usually revolve around urgency replacing discipline. A trader may re-enter without a valid setup because waiting feels intolerable after the previous loss. Position size often increases because the mind wants to recover faster, even though that usually makes the next decision worse. Stops may be widened or removed, normal entry rules get ignored, and traders start jumping into markets or time frames they would not normally touch. In other words, the structure of the plan starts disappearing. When you see urgency, larger size, and weaker rules appearing together, revenge trading is likely already underway. Revenge trading tends to follow a predictable cycle. A normal loss feels irritating, unfair, or personally offensive, even though losses are part of the business. That feeling creates an urge to recover immediately, which leads to a rushed trade before a proper setup is confirmed. Because the motive is emotional, risk rules are often weakened or ignored entirely. If that second trade loses as well, the pain increases and the cycle can start again with even more pressure. What began as one manageable loss can quickly become a chain reaction of speed, emotion, and rising risk. Revenge trading becomes costly because later trades are often both lower quality and higher risk. One planned loss that should have stayed small can turn into several avoidable losses in a short period. Oversized trades magnify the damage quickly, especially when the entries are rushed and the stops are poorly placed or ignored. That combination can erase days or even weeks of steady gains. The hardest part is that these poor decisions often happen exactly when discipline matters most. A trader may survive a planned loss easily, but emotional trading after the loss can do serious damage. The cost of revenge trading is not only financial, it also damages confidence, judgment, and your relationship with your own trading system. A loss leads to anger and impulsive action, then a larger loss brings frustration or shame. If this pattern repeats, the behavior starts to become a habit rather than a one-time mistake. Over time, confidence in the system fades, and even good setups begin to feel suspicious or emotionally loaded. That is one reason revenge trading can keep hurting you long after the actual losing session is over. A healthier mindset after a loss begins with accepting that losses are part of trading and do not require an immediate response. The market does not owe you a recovery trade, and trying to force one usually makes things worse. One trade does not define your long-term performance, especially if it was a valid setup executed correctly. In that sense, a planned loss is still part of the strategy doing its work. Discipline after a loss protects not only your capital, but also your judgment. The goal is not to feel good immediately, but to stay aligned with the process. Alex's trading day shows how quickly a manageable situation can escalate. His first trade is a planned short that loses $100, which is a normal and acceptable outcome if it matched the system. But after taking that loss, he becomes frustrated and re-enters too quickly. This second trade is 3 times his normal size, and he also uses a wider stop than usual. That means both the decision quality and the risk control have broken down. When the revenge trade loses another $300, the main issue is no longer the first trade, but the emotional response that followed it. The lesson from Alex's example is very clear. The original $100 loss was manageable and fully survivable within the plan. The real damage came from the second trade, where discipline was abandoned in an attempt to recover quickly. That revenge trade added another $300 in avoidable loss, turning the day's total into $400. So the extra damage did not come from the market suddenly becoming unfair. It came from trading outside the system. This is why traders must learn to separate planned losses from emotional losses, because they are not the same thing. Interrupting revenge trading starts with treating the pattern as something observable and measurable. Review your last 10 losing trades and check whether you tended to trade again immediately after each one. Look for position size increases, stop-loss changes, or entries that did not truly meet your setup rules. Then separate normal losses from emotional losses so you can see how much damage came from process failure rather than strategy performance. One very practical tool is a cooling off rule, such as waiting 30 minutes after any loss before taking another trade. The goal is not to avoid losing, but to stop a normal loss from turning into emotional escalation. Strong traders are often defined by what they do right after a loss. A disciplined response begins by stepping away instead of reacting immediately. Then review the trade and ask whether it was a valid setup, whether the execution matched the plan, and what emotions were present. Journal both the market details and your internal state so the event becomes useful data rather than unfinished emotional tension. Only return to trading after that review is complete, and only if the next trade fully matches your plan. Mature trading is not about avoiding losses. It is about refusing to let losses control your behavior. Section 4. Patience and consistency. Patience and consistency matter because a trading edge only works when it is executed repeatedly and with discipline. Patience filters out weak or incomplete setups, which protects you from low-quality risk. Consistency means using the same process often enough that results can actually be evaluated. Without patience, you trade too much. Without consistency, you cannot tell whether your results came from the strategy or from constantly changing behavior. Even a good plan can be weakened by impulsive entries, random sizing, or emotional exits. So patience protects selection and consistency protects measurement. In trading, patience is not passive waiting or doing nothing. It is disciplined action that says yes only when your full setup is present and no when it is not. That means you wait for all required conditions, such as trend, level, signal, and defined risk, rather than taking a trade because price is moving quickly. Patience also means not chasing candles or forcing opportunities that are almost good enough. If the rules are not met, there is no trade, no matter how active the market feels. This kind of patience reduces noise, lowers unnecessary risk, and makes your decisions cleaner over time. Patience is still required after entry, not just before it. Many traders wait correctly for a setup and then lose their discipline once the trade starts moving. A small retracement can make them want to cut the trade early, and a move against them can create hope that leads to widening the stop. Real patience means allowing the trade to play out according to the plan, unless the system gives a valid reason to act. That is very different from passively hoping because the plan is still in charge. The key is to let written rules guide decisions while emotions rise, rather than treating every moment of discomfort as a reason to intervene. Consistency is what turns trading from a series of random experiences into a process you can evaluate. If you keep changing your entries, your size, your stop placement, or your exit behavior, then your results become difficult to interpret. You will not know whether the strategy is working or whether you are constantly interfering with it. Using the same entry rules, the same position sizing method, and the same risk standards creates comparable trades. Once you have a meaningful sample, performance begins to tell you something useful. Without consistency, even honest review becomes confusing. Fixed risk is one of the simplest ways to build consistency into trading. When you risk the same amount on every trade, losses stay controlled and results become easier to compare across time. If your rule is 1% risk on a $10,000 account, then each trade risks $100 whether the previous trade was a winner or a loser. That amount should not change because you feel confident, frustrated, or eager to recover. Emotional sizing turns trading into guesswork. Fixed risk keeps position size tied to the plan rather than to your mood. More trading does not automatically mean better trading. In many cases, higher trade frequency creates fatigue, and fatigue lowers decision quality. As the mind gets tired, traders become more likely to rush entries, overlook rules, or take low probability setups just to stay active. That is why overtrading often becomes a loop of more trades, more fatigue, and weaker execution. Patient trading does the opposite by filtering out weak opportunities and preserving mental clarity. Fewer better trades are often much more productive than constant activity. A profitable trade is not always a good trade, and Maria's example makes that clear. Her plan risks $50 to make $100, which gives her a clean 1 to 2 reward to risk structure. But during the winning trade, she widens her stop after entry. The trade still reaches profit, so the outcome looks good on the surface. The problem is that the execution was flawed, because she changed risk in a way the plan did not allow. This is why traders must learn to separate profit from quality. A good outcome can still come from bad process. Single trade results can be very misleading, which is why good traders judge process before outcome. A losing trade can be well executed if it followed the plan from start to finish. A winning trade can be poorly executed if it involved chasing, oversized risk, or changing rules during the trade. That is why review should focus on a meaningful sample such as 20 to 30 trades, rather than reacting to just a few outcomes. Over that larger sample, you can look for repeatable execution, steady risk control, and evidence that the edge is being applied consistently. The goal is reliability in the process, not emotional reactions to isolated wins or losses. Consistency becomes practical when it is turned into a routine. Before the market opens, define your rules, key levels, and risk limits so decisions do not have to be invented later. During the session, wait for the full setup instead of bargaining with partial signals. If the trade appears, execute it with the planned stop, target, and size. Afterward, log both the result and whether you actually followed your rules. Repeating that cycle day after day reduces emotional decisions and makes your review far more useful. One effective way to build consistency is to focus on a single non-negotiable rule for a short series of trades. Start by reviewing 3 recent trades honestly and identifying where your discipline tends to slip. Then choose one rule for the next 10 trades, such as no early entries or no stop changes. Keep the goal narrow so it is easy to track and hard to excuse. After those 10 trades, score how consistently you followed that one rule. This approach keeps your attention on behavior you can control, which is often a much better path to improvement than obsessing over short-term profit and loss. Section 5. Building trading habits. Trading habits matter because markets often move faster than conscious willpower can reliably respond. Strong habits create structure, so you do not have to rebuild discipline from scratch every time pressure rises. Repeated routines help decisions become steadier under stress, which reduces mental fatigue and emotional drift. Motivation alone is not enough, because motivation changes from day to day and can disappear exactly when markets feel difficult. Habits are valuable because they keep useful actions available even when you do not feel especially focused or confident. In trading, that kind of reliability matters a great deal. Most helpful trading habits begin as deliberate, effortful actions. At first, you have to remind yourself to check the plan, define the risk, and follow the routine step by step. With repetition, that same behavior starts to feel more natural and creates less internal resistance. It does not become mindless, but it becomes easier to access under pressure. That is the transition from deliberate action to habit. Stable habits support rule following because they make disciplined behavior more automatic and less dependent on mood. A simple way to think about habit building is through the loop of trigger, routine, and reward. The trigger is the cue that starts the behavior, such as a certain time of day or a specific market event. The routine is the sequence you want to perform, like checking your plan, setting risk, and preparing key levels. The reward is what reinforces the behavior and makes you more likely to repeat it. In trading, the best rewards usually recognize process rather than profit because profit can be random in the short term. If you reinforce disciplined execution instead of outcome alone, the habit becomes much healthier. Good habits need clear triggers. If the cue is specific and easy to recognize, the routine is much more likely to happen consistently. Time-based cues like the market open or daily close work well, and market-based cues like price reaching a key level can also be effective. What usually does not work is a vague trigger, such as when the market feels active. If you cannot clearly tell when the routine begins, the habit will be weak and irregular. Specific cues reduce hesitation and make the behavior easier to repeat. Trading routines work best when they are short, clear, and written down. A written routine is easier to repeat faithfully and easier to review afterward than a routine you try to hold in your head. For example, you might review the economic calendar, mark key support and resistance, check whether setup rules are met, and then decide to enter, manage, or skip according to plan. That sequence is simple enough to use on both busy and quiet days. When routines are too long or overly complicated, they become harder to follow consistently. Simplicity increases repeatability, and repeatability is what turns a behavior into a habit. In trading, you want to reward the process, not just the result. If you only feel successful when a trade wins, you may accidentally reinforce bad habits that happen to make money by luck. A better reward comes after disciplined execution, whether the trade was a winner or a loser. That reward might be logging the trade carefully, checking off a completed process sheet, or taking a short break after following the plan. The key idea is that good execution deserves reinforcement on its own. This keeps your habits aligned with repeatable behavior rather than random short-term outcomes. Habits become stronger through repetition over time, not through one burst of effort. Research often cites a median of around 66 days for habit formation, but that number is only a reference point, not a guarantee. Some behaviors take less time, and many take much longer depending on complexity and consistency. What matters most is regular repetition. A simple daily routine, repeated steadily, usually builds more stability than an ambitious routine done only occasionally. In trading, consistency matters more than intensity because the goal is reliable behavior, not a short-lived burst of motivation. Repetition is powerful, but it is neutral. Whatever you repeat becomes easier, whether it is disciplined preparation or impulsive chart checking. Helpful repetition includes behaviors like reviewing the plan, waiting for setups, and logging trades after execution. Harmful repetition includes constantly checking price, reacting to every move, chasing entries, and breaking rules under pressure. Both sets of behaviors can become automatic if repeated often enough. That is why habit building is not just about doing something repeatedly, but about making sure what you repeat is aligned with your trading plan. A pre-market routine is a good example of how habits can reduce reactivity. Suppose your trigger is 8:45 a.m. Eastern each trading day. Your routine might include reviewing the news, checking the economic calendar, identifying setups, and confirming planned stop-loss levels. After completing that preparation, your reward could be stepping away for 10 minutes before the market opens. That break helps separate preparation from execution and often leads to calmer decisions when trading begins. Over time, the routine becomes easier, and the market open feels less chaotic because you're arriving prepared instead of reactive. The most practical way to build habits is one at a time. Choose one behavior you want to make more automatic and write it as a single clear sentence, such as, "I review my trade plan before every entry." Then run that full habit loop for 10 trading sessions and rate your discipline each day on a scale from 1 to 5. The rating keeps the process visible and gives you feedback instead of vague intentions. If your scores stay low, that usually means the trigger is unclear or the routine is too complicated. In that case, simplify the habit and test again rather than trying to force a weak system.